Well, the latest U.S. inflation report showed more signs of cooling, but does it mean cuts may be on the table in their decision later this month? Joining us now to discuss is Gennadiy Goldberg, head of U.S. rate strategy with TD Securities. Gennadiy, welcome to the show.
Thanks for having me.
All right, so let's start off by getting your take on the morning's inflation report. What do you see there?
Well, lots of signal, a lot of noise as well. Unfortunately, we're coming off of a couple of months of very shutdown impact data. From what we can tell, this is a slightly better report. All on net. I'll give you the bottom line first. It really tells us that inflation is starting to moderate in the United States. It's not coming up as much as people expected. And going forward, what really matters, obviously, aside from the inflation prints, is going to be the labor market. Now, the Fed can look to this inflation print and really say, okay, well, inflation is not materially accelerating yet. Maybe it will be accelerating at some point in the future. We really have to wait and see. So in the short term, this really means that the labor market is going to be a lot more in focus over the next couple of months. Can they cut rates in January? We think unlikely, but the market is pricing in relatively low odds of a cut in March. And of course, that can't be ruled out just yet. This is going to be data dependent. Every meeting is live. Every data point is going to matter. And it is going to be a lot of repricing for markets to do.
Okay. Again, you mentioned those rate cuts. How does that set it up for the rate decision? You said that you don't think that the Fed is likely going to cut in January.
Yeah, the market's pricing in very low odds of a January cut, just about a basis point out of those 25 basis points. So really low odds. It was actually declined even further after payrolls from really kind of a couple of basis points to just about a basis point. But the market's still penciling in about somewhere between 2 and 3 cuts for the rest of the year. So call it just shy of 75 basis points. We're actually looking for 3 rate cuts. We expect a cut in March, June, and September as the Fed kind of dials in where they think neutral is, which we think is around 3%. So we still think they have enough fodder to actually continue to cut rates over the course of the year. They're just in no rush. Inflation doesn't seem to be coming down dramatically, but it's also not rising. The labor market seems to be a little bit on the softer side, and it is kind of softening over time. But again, it's not falling off a cliff. So it really allows them to kind of be in this wait and see type of environment for even longer.
All right, of course, now we're just 1 week into the new year, and the big headlines, of course, is around the Fed right now. The U.S. Justice Department probing Fed Chair Powell. How should investors be viewing this news?
The initial reaction was relatively negative. Interest rates sold off. The curve actually steepened. Really on the expectation that an erosion of Fed independence, which is quite crucial for any central bank, would lead to higher inflation down the line. May need more rate cuts in the near term if somebody takes over who's more dovish, but it means that maybe the central bank is not quite as credible on their inflation fighting capacity. That's really changed. Powell came out swinging. He didn't have to release a video. He could have just simply released a statement. He called it an attack on central bank independence. He said there was ulterior motive. So at the end of the day, Powell has materially pushed back. It's garnered a lot of support within Congress from former Fed chairs, from former Treasury secretaries. So really, it's kind of backfired on the administration, where the Fed is actually pushing back materially. And I think markets are liking the fact that that pushback suggests maybe even more Fed independence down the line. It is going to it's going to have to be something we watch. We've got the Lisa Cook trial next week. That's Governor Cook. The Trump administration has been trying to push her out of her seat. If that's successful, that could erode Fed independence as well. So there's a lot more to watch on this front. But for now, the markets seem a little bit more sanguine, even though this is really an attack on Fed independence and Fed credibility.
Yeah, I think there's a lot of concern about that independence. Do you think that this situation could have any potential implications for rates, despite the pushback from Fed Chairman Powell?
Absolutely. I mean, if we see the central bank, the Supreme Court argument really moving in the way of the prosecution, the Trump administration, it could really start to pressure interest rates higher. The worry is, Governor Cook was accused of mortgage fraud. The administration was trying to remove her from office just based on those accusations. And the question in front of the Supreme Court is, do they have the capacity to do that? If the Supreme Court rules no, or if they're critical of the administration's approach, I think it would reinforce Fed independence, and I think the markets would breathe a sigh of relief. If it looks like they're siding with the administration, if they seem to be conducive to those arguments, it could actually make markets worried that perhaps not just Governor Cook is on the firing line, but so is Chair Powell, and so is the rest of the FOMC board, and whoever replaces them will be much more keen to actually take interest rates sharply lower, whether it's justified or not. That could send inflation expectations sharply higher, and it would probably send long-end interest rates sharply higher as well.
Okay, so getting back to the inflation report, of course, we had last week's jobs report. How's the economy looking right now? And again, what are you expecting for rates through 2026?
Yeah, so I'll start with the last question first. I mean, we are expecting rates to gradually decline. That is based on our expectation that over the course of the year, the economy will continue to gradually moderate. We're not looking for a recession, but we are looking for a little bit of slowing down on the labor market front, enough to keep the Fed a little bit nervous. We're also looking for inflation on a year-on-year basis to finish the year at about 2.5%. So actually lower than we are today. And that would encourage the Fed to get rates back towards the 3% neutral level, which we think it really is their target. So we're not looking for a recession. We're not looking for a reacceleration in the economy as well. A little bit of a kind of a steady as she goes type of economy with risks tilted to the downside, which again tilts the risks to rates to the downside as well. We're still looking for the 10-year to finish the year at about 3.5%, so well below market consensus.